Welcome to Building the Future. I'm your host, Kevin Horick. You can check out new episodes of the show every Tuesday and Thursday at 2 p.m. If you missed an episode or want to get more information about the show, please visit buildingthefutureshow.com. SoupX, the Startup Expo, North America's premier startup conference, is March 6th and 7th, 2017, in sunny Fort Lauderdale, Florida. Affordably priced, SoupX is a 2-day international conference featuring workshops, panels, speeches, a $50,000 startup competition, and over 100 exhibitors. For more information, go to sup-x.org. Welcome back to the show. Today we have Rob Belcher. He's the managing director at SaaS Capital. Rob, welcome to the show.
Thanks. Good to be here.
Yeah, I'm excited to have you on the show. You guys have kind of a different take on the capital side of things, but maybe before we kind of get into that, let's get to know you a little bit better and start off with where you grew up.
So I grew up in Golden, Colorado, just outside of Denver, and loved it. It was amazing, and I think if I hadn't been there, I would have gone to college at CU Boulder and would live there my entire life. It's an amazing place to be, for sure. But growing up there, I wanted to go explore and see what else was out there. So I did my undergrad about as far away as you can and still stay in the U.S., and that was Colby College in Maine, Central Maine.
Okay.
And loved that as well. Met a lot of amazing people and really liked having new experiences and being in New England. And did the traditional small New England liberal arts thing where you end up in either Boston, New York, or D.C.
Sure.
And my first job was at a research and consulting firm in Boston.
Okay.
My whole family in Denver is in the energy industry, and I kind of followed in the footsteps, and I was a commodities analyst for Wood Mackenzie, which is an Edinburgh-based research and consulting firm in the energy industry.
Okay.
So I did some natural gas, power, and oil analysis there for a number of years. And that's doing research and consulting. You know, you work with, in our experience, we worked with a lot of the super majors and a lot of transportation companies, and worked on these amazing infrastructure projects or development projects. But as a consultant, you do the work and you kind of hand it off. And I got to the point where I was wanting to take more of the ownership, the risk.
Gotcha.
And I figured, in order to do that, an MBA was in my future. To sort of transition, learn a little more finance and accounting, and maybe do a slight pivot on my career. Also, good opportunity to be back out west, and ended up at the University of Washington for my MBA, the Foster School of Business.
Okay.
And yeah, go ahead. Sorry, I'm kind of rolling.
No, it's good. It's good. I was just going to say, what made you kind of decide to kind of go into an MBA, and did you work through that, or did you just do it full time?
Yeah, it really was. So I was an economics major undergrad.
Sure.
And at Wood Mackenzie, I was basically an economics analyst. We did price forecasting, supply and demand modeling. It was very much legitimate economics.
Got you.
And it used my skills, and it was great, and I was really good at it. And we had a great team, and we did some amazing work. But like I said, I think the bridging from there to being in a business development, corporate development role at Shell or Total or something, I would need a more accounting and finance experience and background, and that's what was missing. I didn't know much about corporate finance. I knew sort of bare bones accounting, but more about accounting and things. So, I dabbled. I looked around and realized quickly that I just didn't have the skill set to jump into working for a major in an M&A, corporate development, business development role, or a hedge fund or a private equity fund or something like that. So that was the realization, and I decided to do full-time to give myself some time to research other options and look around,
right.
As opposed to trying to work through it. And I stumbled into the venture capital world. I had planned to go work for a hedge fund, private equity fund, or like I said, one of the actual participants in the market. And being in Seattle, which is not a big energy hub,
Sure.
got more into the tech world. I took a couple classes at UW that were really good on venture capital and technology and entrepreneurship, and did an internship at Voyager Capital, a Seattle-based Series A venture firm. And that sort of took me in a different direction, but it's been great. So I can talk more about that. But it wasn't the intent, and that's just kind of how life is. but it's been fantastic.
Sure.
So when I was
No, go ahead.
yeah,
Keep going.
I'll pause, but I can keep rolling.
Yeah, keep going.
While I was at Voyager, the team there founded and funded a company called Lighter Capital, which is a Seattle-based specialty lender that does royalty-based lending. So they'll give you a loan, and instead of sort of monthly payments like a mortgage, their payments are based on a royalty of your revenue. So your payments fluctuate as your revenue goes up and down. In very flush months, you pay a lot. In lean months, you don't pay very much. And I fell in love with that because that actually did tie back to the energy world. A lot of energy projects are funded by royalty agreements.
Right.
And so I knew how those work, and I knew the advantages of that. And so I got really excited about it, and actually ended up joining Lighter Capital after I graduated. And that got me into this world of debt finance for startups, for early stage software companies.
Okay. No, that makes sense. And you were there for a few years, and then now you're the managing director at SaaS Capital. So how did you kind of become part of that team, and what exactly is SaaS Capital?
Yeah, that's great. So I was one of the very early entrepreneurs at Lighter, helped build it up, and we got to raise a Series B.
Okay.
And that was a good time for me to step out. I'm a generalist, I would say. I like doing a little bit of everything. And now it's a quite a large company of 40 people. There's full-blown departments for marketing and underwriting and that kind of thing, which is great. That's great. It was a very good experience for everybody, and it was a good time for me to step out. So it very successfully built that company, and I started looking for a smaller opportunity again where I can kind of wear all the hats that I want to anyway.
Sure.
And had met Todd Gardner, who's the founder and managing director at SaaS Capital, at a conference, and reached out to him, and just to kind of network and see what SaaS Capital was all about. And he happened to be raising Fund 2 and was looking to add a partner, particularly on the West Coast, and it was just really serendipitous. And we get along really well. We have a similar worldview, and so I joined for Fund 2. But he ran Fund 1 himself, and then for Fund 2, like I said, he wanted to add a partner. So I joined in mid 2014. We closed the fund around the turn of the year, January of 15. So we've been deploying the fund for 2 years.
Okay, so for people that don't really understand kind of the space, what does that even really mean? Like you say Fund 1, Fund 2, what does that really mean?
Yeah, that's a good question. It's really good. So I can answer that question by giving some contrast.
Sure.
Lighter Capital, my previous company, is a company.
Okay.
Kind of like any company, right? And like I said, we were building a team and doing that kind of thing. And now SaaS Capital is a company as well, but it's also a fund manager. And so what that means is our business is to manage other people's money, just like a venture capital firm or a private equity firm.
Okay.
It's a traditional, how that's defined is, and we call it a traditional general partner, limited partner relationship. We're the general partner. We manage the fund. The limited partners are the institutions and high net worth individuals who have committed money to the fund. And so they earn the return that we generate by making the loans and then managing them through, and then realizing the returns on them. Does that make sense? Or I can provide more detail.
No, that makes sense.
And then I guess I think importantly, for people who aren't familiar with the industry, you might wonder how we make money. The company, SaaS Capital.
Sure.
So all funds earn a fee for managing the money, and that basically pays salaries and sort of operating expenses.
Okay.
And then the bonus component is called the carried interest, and you might hear about it in various political discussions. It's part of the tax code, and it's commonly something that gets discussed in tax code discussions. The carried interest component is a small profit sharing that the management company earns on the return they generate in the fund. So most of the returns go to the investors, and a small piece goes back to the management company as sort of the bonus for doing a good job above some threshold. There's usually a minimum return, and if you meet that, then you profit share in the balance, whatever's left over above that.
I got you. Okay. So how does it kind of, like, if I'm I have money to invest. I come to you guys and then kind of walk me through that whole process.
Yeah, so that's on the fundraising side.
Sure.
Most commonly, I would say money managers or management companies approach capital sources rather than the other way around.
Okay.
It's rare that it's not rare, but because it's everyone's business, right? So they're looking for investments also. So it's a good question. But generally speaking, it's a manager will go talk to other sources and pitch them. It's literally you pitch your own business as well, just like a startup might pitch a VC. The management company gives their pitch on their thesis. We focus on this. We do this. We're a clean tech venture capital firm. We're an energy private equity firm. Whatever their thesis is, and they go find pools of capital to invest in their fund based on what their investment theses are, what those capital pools investment thesis is.
Okay. And so if somebody wants to get funding from you guys kind of have a bit of a different kind of angle at it. Like, do you want to explain how does somebody kind of approach you guys, and what do you guys look for, and kind of how do you traditionally do kind of investing?
Yeah, that's great. We're a lender. So SaaS Capital, it's a great name, very descriptive. It's
Sure.
It's kind of boring, but it's exactly what we do. We provide capital to SaaS companies.
Okay.
Subscription revenue, software as a service company. SaaS stands for software as a service.
Right.
So think of things like Spotify or Netflix, things you subscribe to and pay regularly.
Sure.
And we lend money to those companies. Specifically, we lend money to business-to-business subscription software companies. So Netflix and Spotify are a good example of what it is, but we wouldn't lend money to them because they're B2C. We focus on B2B.
Okay.
But that's the business model.
Sure.
And we lend between $2 million and $10 million to those companies that have $3 million in revenue and up.
Okay.
So we're not very early. Companies are established. And I'll explain more of sort of our thesis, which is companies are established. Maybe they've raised some angel funding or even a Series A. They've built the product and they've started selling it, and they have good sales traction. And now they want to pour some fuel on the fire.
Sure.
And really grow. Doing a Series B or raising equity at that point is a really expensive way to just do sales and marketing. And so our thesis is, you've de-risked a lot of the company by building a product and having customers.
Right.
You should have access to cheaper capital to execute at this point. And we provide that via our lines of credit, our debt.
Okay.
And so we're usually used in lieu of a Series B or an equity round as an alternative, non-dilutive, non-controlling way for a company to execute and grow.
Okay. So I'm curious then, like, obviously probably most people have heard of a line of credit. Does it work the same as kind of a personal line of credit, or is it different?
It's a really good question. I think people's expectation or interpretation of what a line of credit is varies quite a bit. So it's a really good question. The reason we structure it as a line of credit is we're saying, hey, we'll give you $4 million to go grow. Your company is creditworthy enough to deserve that. It's available to you, but it's silly for you to, basically borrow it all today and pay interest on it all today for the next 18 months while $3 million of it sits in your bank account and you slowly spend it down.
Okay.
So the line of credit structure allows them, it's kind of, most people treat it as a committed round, but they just draw it down over time gradually as they need it and only pay interest on what they borrow over time as well. So it's a more interest expense efficient way to do it. So not only is it better than equity, right? It's no dilution and it's cheaper,
Sure.
but also it's better than a term loan because you're not over borrowing up front.
Okay, so just so I'm clear, like if I go to the bank and get $1 million line of credit, I'm obviously like, they don't break it up into, I don't know, $100,000 chunks, right? Where you guys could potentially do that, or a $500,000 or a $250,000, something like that?
Yeah, I think the important differentiation between a line of credit from a bank and us is most people use a bank line of credit to smooth cash flows.
Okay.
And so in lean periods, they'll draw on it and they'll use that money.
Right.
And then when they get big customer payments, they'll pay it down to zero or very low, right?
Got you.
Our borrowers might do some of that with the money, but more importantly, they're gradually increasing their borrowings because they're spending into the round.
Sure.
And usually towards some event. So they might sell the business, they might raise an equity round, that kind of thing. It's designed to get paid down over time too, if they want to go that route.
Right.
But it's not designed to go up and down, up and down, up and down like a cash flow smoothing line.
Got you. Okay. So how does that work then? Like, you give me a bunch, and then if I need more, sorry, let me back up. So we agree on like a max amount that you're willing to kind of lend me on a line of credit, and then we decide kind of what the initial amount is, and then I just like reach out to you, say, okay, I need a bit more now, or I always have access to more. Like, how does that kind of work?
Another great question on the structure. There are a couple moving pieces, so that's great. So I would say, I would be really clear here. We call ours an MRR-based line of credit.
Okay.
And that stands for monthly recurring revenue. And monthly recurring revenue is the GAAP accrued revenue that SaaS companies generate. It's the way SaaS companies' revenue is accounted for. And we base our lending off of that.
Okay.
Just real quickly and importantly, that's different than royalty-based lending or revenue-based lending, which is what SaaS Capital does, my previous company.
Right.
So just to be clear, so the royalty thing is based, the repayment is based on revenue. Ours is the amount that you can borrow is based on your revenue. So let me talk more about that and answer your question. But I just wanted to kind of separate those two things because sometimes there's confusion out there.
Sure.
So you and I decide on the size of the facility, and that doesn't matter. It could be $2, $3, $4, $5 million bucks.
Okay.
But underneath that, we on our side, SaaS Capital, we do our analysis on the business, and we determine a multiple of your monthly recurring revenue that we're comfortable lending you at any one time. And ours is typically 3 to 7 times monthly recurring revenue.
Okay.
So a 6x multiple is nice, easy math because it's half your annual. 6 times monthly, is half your annual. So say you're a $5 million company.
Sure.
You could borrow from us $2.5 million, half your annual, right now.
Okay.
But it's tied to that MRR. So every month, as you add monthly recurring revenue, as you grow, the amount you can borrow under the line increases. So say we did a $4 million line, you'd have $2.5 million available under the line. So you could draw up to $2.5 million, but no more. We wouldn't give you any more than $2.5 million.
Right.
But every month, as you add revenue, you can now draw 2.6 million, 2.7, 2.8, 2.9. And so it keeps growing formulaically. And those lines are committed for 2 years. So you have a 2-year draw window where you can draw down. So most people draw $500K, $1 million at closing. And then, like you said, like a month later, they call us, they say, we've made a hire or we want to do some more marketing. We'd like to draw $200,000. And so they do that. And we do that all the time.
Okay.
Some borrowers, do 2 big draws over the 2 years, and that's it. Some draw monthly.
Okay.
It depends on their own strategy and how they like to work.
Got you. So do you guys ever potentially convert to equity at some point, or you're not into that at all?
That's no. So we don't do any of that.
Okay.
I guess I can answer a question you haven't asked yet, but I think it's relevant here is kind of how it terminates.
Yeah, that was going to be my next question, to be honest.
Yeah. Excuse me. We don't convert into equity. That's not how it terminates.
Okay.
But it after the 2 years is up, so I'd say it can terminate, or 3 things can happen after the 2-year draw period is up. One is we can renew for a 3rd year. So say it's going great, you really like it, you want to add to it, maybe do now a $6 million facility, add another $1 million to it. Great, no problem. We can do a 3rd year. You can do something to pay us off all at once, like raise a really big round and pay us off as part of that, or sell the business and pay us off as part of that. Importantly, too, you can raise a round or sell the business and we can stay in depending on how the deal's structured, too. But that's one way we can get paid off. And then lastly, it's designed to just turn over into a term loan at that point. So whatever you've borrowed just starts to amortize down just like a mortgage over 3 years. So it's designed to smoothly allow you to pay it down. It's not a bullet. You don't have to owe it all at once or anything like that. It converts over to a term loan, and you pay it down over 3 years.
Okay. So I'm curious then, is there specific verticals that you guys prefer to lend money in, or it doesn't really matter, or where do you guys kind of play in that space?
Yeah, that's a good question. I think I might broaden it up to sort of criteria or what we look for,
Sure, that's
and
great.
kind of who we talk to. Yeah, so we are very niche in the fact that we lend only to SaaS companies.
Okay.
Therefore, we're geographically totally wide open, at least as far as our lawyers and our accountants have allowed us to go so far,
Right.
which is U.S., Canada, and the U.K.
Okay.
So we've got 4 portfolio companies in the U.K. We just closed our first one in Canada, and everybody else is in the U.S.
Nice.
So geographically open, yeah. As I said, companies with $3 million in revenue and up, but vertically pretty agnostic. We've got healthcare, IT, ed tech, your typical sort of business tools, sales enablement, marketing, automation tools, that kind of thing. So pretty wide open, generally speaking, business tools, some e-commerce tools. So that's, I'd say vertically we're pretty agnostic.
Okay.
But the key criteria for us is just credit worthiness. Again, we're a lender.
Right.
We're not looking for the next Facebook or the next Google. We're looking for a company that's doing great things. It is exciting. We certainly love the story.
Sure.
We're not totally agnostic to the story, but we want to, hear a good story and make sure it's an interesting company that's growing. But more importantly, is just will they be able to pay us back?
Right.
So all of our criteria is more geared around the creditworthiness of the company. So growth, customer and revenue retention. Make sure customers aren't leaving in droves.
Right.
And good margins. Those are things we look for. And
Sure.
burn rate, how much they're burning, and
Yeah.
are they going to run out of cash anytime soon, or do they have a decent runway? So it's more geared around creditworthiness.
Sure. Okay. Because I guess my next question would be around obviously you're not looking for a board seat. Then I'm assuming you guys aren't really doing any mentoring, or are you guys kind of as well? Because sometimes people get an investor because they're looking for somebody to mentor them as well, maybe make some connections, open some doors for them. Do you guys do any of that, or you're just fully kind of focused on just providing capital?
Yeah, another great question. It's on so there's actually lender liability laws, and so we don't take board seats for those reasons. We don't want to be liable. We can't be liable. So no, we're pretty hands off, and that's actually one of the values of our structure, right? Is you've been doing this forever. It's your company. You want to maintain control. That's fine with us.
Sure.
That's great. We have covenants, certainly. You need to, kind of follow the loan rules. But aside from that, you can do it. You can pay yourself whatever you want, or that kind of thing. So control is based on the loan docs, but not at the corporate level. On the mentorship side, yes, certainly. I mean, companies definitely. I think that's what venture capitalists at least advertise as their greatest value, is that sort of value add, the network, all that stuff, right?
Yeah.
I think some of that, there's a spectrum of value there.
Yeah.
Everyone advertises it. I think there's certainly a spectrum there. But that's why people historically have raised venture. We similarly, we to sort of our strategy of being kind of in between a bank and a VC, we're sort of between a bank and a VC on that front as well. I'm just trying to figure out where to start. We do some work with our portfolio companies and help them, especially on their reporting and their metrics and things like that, because that's also important to us.
Sure.
We're pretty hands off on strategy, what markets to target, that kind of thing, but happy to chat about it or introduce to folks that we know. But importantly, the cool thing about our portfolio is because it's so concentrated on just B2B SaaS companies, no one is really competitive with each other in our portfolio, but they're all going through the same issues. They're doing the same kind of, sales, should I build an outbound sales team? Should I build an inbound sales team? What are you guys doing on marketing? And so we get our CEOs together twice a year, and then we, obviously maintain a CEO email list. And so they interact and share knowledge and that kind of thing with each other, which has been really, really valuable and really interesting.
Sure. No, that makes some sense. And you guys are in some big kind of cities kind of on both coasts where obviously there's pretty big startup hubs, right? And there's companies getting, funding kind of in both. Obviously, you being kind of in the Seattle area and New York and stuff, those are big kind of company hubs, right? I'm not saying other places in the North America aren't, but like you guys are in some of the big hubs in kind of North America.
Yeah, that's right. We try and be involved in our communities for sure. Through my work at Voyager when I was there, I've got a good network, and try and maintain that, and we do some panels and mentorship and stuff at some of the incubators and things, for sure. And then, we actually do our CEO events on each coast. You're exactly right. Cool. We do one in San Francisco and the other one in New York, just because of travel schedules and where our portfolio companies are based. It's easier or harder to get to one or the other, so we try and mix it up a little bit.
Sure. So walk me through the process. Like, I meet all your kind of base criteria. I apply to get a line of credit from you guys. And I know it's probably different per company, but what's on average the range it takes from kind of me submitting the documentation to you guys? And what do I need to submit to before, I can actually start drawing from that line of credit? Is it like weeks? Is it months?
Yeah, that's a good question. It's pretty similar to if you were to do a venture round. We certainly focus on certain other things. Again, mostly around, cash collection, stability of your application, things where we could lose money as a lender.
Okay.
Excuse me. And then, it may be less on sort of the massive scalability of the tech or, things that venture capitalists might want to dive into, or that, they usually typically do really big deep dives on team. We do too, but not to the same extent. But so our diligence is similar, though. That's the point. And it's, we look at financial statements, we look at the accounting policies, we look at all the organizational documents and things like that. So we usually get to a term sheet in 10 days or so from our first conversation.
Oh, wow.
And that's with some material, some financial statements and a deck and that kind of thing, and some conversations. And then from there, it moves into legal, and that just takes time.
Yeah.
And we do a site visit and meet everybody and that kind of thing. So anyway, we close in about 3 to 6 weeks after a term sheet. So it's about 2 months.
Pretty
start
quick,
to finish.
Though.
Yeah, we try and streamline it as much as we can, for sure. So that is a goal. And once you sign a term sheet, everybody wants money, and we want to be done too. We want to give you the money. We don't want to sit around for too long. So we try and move through legal pretty quick.
Sure. No, that makes some sense. So I'm curious then, do you guys, is there like a certain amount of companies a year that you typically kind of give lines of credit to, or does it really kind of fluctuate?
We are, again, as a lender, we're happy to do as many lines of credit as we can.
Okay.
We're not looking to make our 3 or 4 bets a year like a venture firm.
Right.
And similarly, I guess, a venture firm will typically make one bet on a given, you asked about vertical before.
Yeah.
They'll make their one bet on virtual reality or car automation or something. We're not like that. We don't want to have any direct competitors, but we're lending money, and we're not on the board. We don't see strategic plans and things. So we can have companies that are a little closer than a VC might do. So anyway, point is, as many as we can do, and we're on about 1 a month or 10 a year.
Wow, that's a lot.
Kind of pace. Yeah.
We've
done 40 across the 2 funds. We've done 40. We've lent money to 40 companies. So it's a good pace. It's great.
So you've mentioned a few times about like 2 funds. Like why are they broken up, and like how do you decide which fund to pull money from? Yeah,
it's a good question. They are. We don't decide. They are broken up by time. So you go do fundraising, you raise a fund, and it's a set amount of money. Okay. And then you spend the next couple of years deploying it. And when you run out of that, you go raise another fund. Fund 1 was raised in 2011 and 12. And again, I had nothing to do with it. It was complete and closed before I joined. Okay. They had deployed all that capital and they needed more. So we go raise, Fund 2. And we're actually getting close to the ramping up for Fund 3, in fact, as well, because we're getting fairly close to deploying all the capital in Fund 1.
I see.
So it's just a matter of,
Would you go back to people that put money in Fund 1 and Fund 2 for Fund 3? Is that something you'd commonly do?
Yeah. I guess generally speaking, it totally depends on the manager.
Okay.
So aside from SaaS Capital, just looking at the broader VC, private equity, hedge fund community,
Yeah.
it totally depends on what people's strategy is. Maybe their first fund was quite small, they did really well, and now they want to raise a huge fund, so they need to go to larger investors, people with more money. So it totally depends. We've been lucky. We've got a really solid limited partner base that's mostly followed us from Fund 1 to Fund 2, almost all, in fact. And we'll probably continue with Fund 3 as well. So it depends.
Okay. The other thing I'm curious about is, say I start a company and I raise a bunch of, I don't know, like seed money or angel money or venture money, or like I've raised a bunch of money and maybe I only own 50% of my company and the other 50% or whatever is owned by a few kind of investors or outside kind of stuff. Do you guys still invest and give kind of a line of credit to a company where they have kind of other investors as well if they meet your criteria?
Sure. Yeah, absolutely.
Okay.
Assuming they get board approval to do the line of credit, there's no issue there. The one thing, and it's not an issue at all, it just needs to be documented correctly, is if they have founder loans. So if it came in if that investment came in as equity, that's fine. It's equity is equity, it's separate than debt. But in the capital stack, their debt is debt. So if it's a convertible note, or if it's a straight sort of investor loan or even a founder loan, that's debt. We're debt, and we're first position debt. We're senior secured debt. We come in as on all assets lien on the company. First position, if something goes wrong, we're the first to get back. So those loans need to be subordinated to us, and that can take any kind of shape and size depending on how they're structured and what they're looking for. But that's just something I'd call out is, even though everyone might be treating it as equity, if it's technically debt, it's technically debt and it has to be taken care of, especially convertible debt. I think that's the one that people always get surprised by.
Okay.
And again, not a big deal. It's just a document between us and the other lender.
Sure. That makes sense. So when you guys are doing your kind of vetting process, do you meet with the founder and the team in person? Because you guys have companies kind of spread out globally. So do you guys meet in person within that first kind of couple of months?
We do before we close, but not before a term sheet necessarily. So after we sign a term sheet as part of our diligence, we do a site visit and we do meet everybody then.
Okay. Just because you guys would obviously have to fly over to the UK. You mentioned you have some deals over there or up to Canada or...
Yeah, that's right. Todd actually just got back from some diligence in the UK, and he's been talking about all week how productive he was on those 36 hours that he had on Monday when he flew back. So he got to work for 30 hours or something.
Sure.
Yep. No, we go visit everybody. And usually it's not too bad. The UK is a little bit of a slog, but not too bad.
Sure. No, that makes some sense. So I'm kind of curious, like, you guys are just focusing on kind of providing these line of credits. Are you guys looking at moving into other ways of giving capital to companies, or are you just kind of going to stick in this kind of space?
It's a great question. I think I can answer that by saying that Todd founded this company after being a venture capitalist for 10 years.
Okay.
So he did that for 10 years and actually was trying desperately to find this solution for his companies. They did an A round. They were growing. He didn't want to have to go do a B round just to finance growth. So we are both, and through my background of helping grow Lighter for several years,
sure,
and seeing how powerful it can be, we both really like what we're doing. We see the value of it. It's been really successful for our 40 portfolio companies. And, on our website somewhere, the number of hundreds of millions of dollars of equity value that we've helped create and save for entrepreneurs is real. It's real, and it's great. So we like it. We are always iterating and evolving ourselves.
Sure.
We don't have any immediate plans to do anything else, but we're happy to be flexible and creative if somebody needs something. We do have that advantage over like a bank. We do have some flexibility in our mandate and what we can do. But for now, we're enjoying what we're doing.
Sure. No, I'm always just kind of curious, right? Because I think, like you just kind of mentioned, at least in my experience, I haven't had. Well, you're kind of the first company and person kind of doing this kind of lending to companies, right? And so I'm assuming that you've gotten asked this before, whether it's from a company that's looking to get kind of a line of credit from you guys, and then probably from the investor side saying, I want to put X amount of dollars into this fund and you guys can lend this as a line of credit, but I want to also risk a certain portion of this. Do you guys do VC funding? I don't know, pick a category, right? So it makes some sense.
Portfolio companies do every once in a while ask, or not, or, prospect companies, I guess, before we get too far with them. They ask, would you ever follow up this with an equity round, or do you convert into equity? Those same questions we've talked about today too. So, and like I said, as of now, no.
Right. No, that makes a lot of sense. So I'm curious, is there anything else that you guys are kind of, or any industries that you guys are hoping to maybe invest in kind of 2017 and kind of beyond? Just for anybody out there listening, is there kind of any verticals that you guys are kind of looking for, or it doesn't really matter just because of the line of credit kind of thing?
Yeah, there's a couple of interesting points there. I think just through our backgrounds, we talk about this every once in a while internally. Todd has a little bit of a penchant for healthcare IT,
okay, sure,
in the healthcare market, and I'm more. I don't understand it and would love to avoid it altogether. On the flip side, through my background, I love energy and sort of field services stuff and agriculture. Sure. I think there's some interesting things there, and so I'm always keen to talk to those companies. But we don't actually, aggressively go after a vertical. I get excited and interested when I get to meet one.
Sure.
I would say the other thing that's related to your question, but not actually part of it, is just macro. We're keen on the macro environment right now, and rates are rising. We've been in a bull market for 7.5 years now, which is I think it's the fourth longest of the last 60 years. So, if data were to tell us anything, mean reversion, within the next 3 or 4 years, we're probably looking at a recession or at least a cooling off. Okay. So those are just things that are on our mind that we're thinking about.
Sure. No, that makes a lot of sense. But Rob, we're kind of coming to the end of the show, so maybe let's close with mentioning where people can get more information about yourself and SaaS Capital.
Sure. Yeah, I really enjoyed it. Thanks for the time. SaaS Capital is SaaS-Capital, CAPITAL.com. That's our website, and you can hit me at rbelcher, B as in boy, ELCHER, at SaaS-Capital.com, and I would be happy to chat anytime.
Perfect, Rob. Well, I really appreciate you taking the time out of your day to be on the show, and I look forward to keeping in touch with you, and have a good rest of your day.
Yeah, awesome. Thanks, Kevin. Really enjoyed it. Take care.
All
Thanks,
right.
everyone.
Okay, bye.
Bye.
Thanks for listening. The music for the show is done by Electric Mantra. You can check them out at electricmantra.com and keep building the future.